October 19th, 1987. The day that would pass into financial history under a name that still makes professionals uneasy when they say it out loud: Black Monday. In a single trading session, the Dow Jones Industrial Average lost 22.6% of its value, not over the course of a quarter, not over a brutal year, but between the opening bell and the closing print on one seemingly ordinary Monday. Fortunes that had taken decades to build were wiped out before lunch. Traders on the floor of the New York Stock Exchange stared at the tape in disbelief, some shouting into dead telephones, others standing silent while prices collapsed in front of them. By the time the closing bell rang, the market had suffered the worst one-day percentage decline in its entire history. If you're into money and investing, subscribe and support this video with a like. Now, let's continue. What made the event even more terrifying was that there was no clear villain to blame. There was no surprise declaration of war, no assassination, no implosion of a major bank, no catastrophic corporate scandal. Economists combed through the news and found nothing that could justify such a violent move. The explanation, it turned out, did not lie outside the market at all. The market had done it to itself. A mechanism that had been sold as a way to protect investors had instead created a self-feeding collapse, a feedback loop in which selling pressure triggered more selling, which in turn pulled in even more forced selling, until liquidity disappeared and the system effectively attacked its own foundations. That mechanism was called portfolio insurance, and understanding it is not just an exercise in financial archaeology. If you are investing in 2025, or even simply have a retirement account linked to the stock market, what happened in 1987 should concern you deeply. The reason is simple. The same structural idea that produced that crash is alive today, only on a vastly greater scale. The technology is more advanced, the labels have changed, and the marketing is slicker, but the underlying logic and the type of risk created by it remain strikingly similar. In many ways, the modern market has turned the 1987 setup into a much larger and faster version, a system that can move billions in milliseconds and amplify small shocks into full-blown crises. Most of Wall Street will not talk about this openly. Financial media prefers comforting narratives about long-term growth, diversification, and the wisdom of staying the course. Yet, if you listen carefully to people who truly study market structure rather than just stock tips, you will notice something. They are increasingly cautious. They are raising cash, hedging their exposure, diversifying away from assets that are vulnerable to mechanical selling. They are not predicting the precise day or hour of the next crash, but they are absolutely convinced that the structure of the market almost guarantees another violent air pocket. The only question is, what spark will light it? Before we break down what is happening now, I want you to participate for a moment. If you are watching this and you have any money in the stock market, whether through individual stocks, index funds, or your retirement plan, think honestly about your situation. Do you truly understand what could happen to that money in a single day if the structure turns against you? Do you understand how many of the products you hold are programmed to behave automatically when prices fall? Share your thoughts in the comments. And if you want to keep learning about the risks that almost nobody is explaining to you, subscribe, because this story will shape how the next crisis unfolds. To really grasp the danger in front of us, we need to go back to the mid-1980s. By then, the stock market had enjoyed a long and powerful run. From the 1982 lows, the Dow Jones more than tripled over the next 5 years. Inflation, which had haunted the previous decade, had been tamed. New technologies, from personal computers to improved telecommunications, were reshaping business. Wall Street was riding a wave of optimism. There was talk of a new era in which old metrics no longer applied, and markets could keep rising because the economy had fundamentally changed. If that kind of language sounds familiar to you in 2025, it should. Beneath that optimism, however, a new form of engineering was taking hold inside institutional portfolios. Academics and quantitative analysts had popularized a strategy they called portfolio insurance. The idea seemed brilliantly simple. Use mathematical models and computers to replicate the effect of owning a put option on your portfolio without actually buying options. In everyday language, this meant designing a system that would automatically sell risky assets like stocks and move into safer assets like treasury bonds when the market started falling. If prices declined, the computer would sell part of your portfolio, reducing your exposure and theoretically limiting your losses. The program would then buy back stocks when conditions improved. On paper, this sounded like a revolution in risk management. Instead of relying on a human manager to decide when to cut exposure, you could program rules into a computer and trust it to act at lightning speed. Large pension funds and institutions loved the concept because it promised downside protection without the ongoing cost of buying actual options. By the autumn of 1987, portfolio insurance strategies controlled tens of billions of dollars, a significant share of the free-floating stock market. The crucial detail is that almost all of these programs were built on the same basic logic. When prices fall by a certain amount, sell stocks. Then, if prices fall further, sell more. To see why this created a time bomb, imagine you manage a stock portfolio worth $100 million. You hire a firm that offers portfolio insurance. They install a computer system that constantly monitors the market. The model says that if the index falls by 5% from its recent high, the program should automatically sell perhaps 10 or 15% of your equities and buy bonds instead. If the market falls another 5%, it sells another slice, and so on. As long as you are the only investor using this system, it might work reasonably well because your selling will not overwhelm the market. The problem is that you are not alone. Hundreds of institutions adopt similar programs, all of which use variations of the same rules. Now, imagine the market begins to drift lower. Perhaps interest rates have ticked up, or some earnings reports disappoint. Prices slide a few percent, nothing that would normally be cause for panic. However, that decline is enough to trigger the first layer of portfolio insurance selling. Computers at several large institutions start dumping stock index futures or selling chunks of their holdings. That additional selling pushes prices down further. Once the decline crosses the next threshold, more programs trigger. Their selling accelerates the fall, which in turn activates still more programs. What began as a normal pullback mutates into an avalanche, not because anyone believes new information justifies such a move, but because the rules embedded in the machines demand it. That is exactly what happened on Monday, October 19, 1987. The market opened weaker after a series of down days the previous week, but there was no single piece of catastrophic news. As prices slipped, portfolio insurance programs began to kick in. Many of them operated through the futures market, where they would sell stock index futures contracts when prices fell, expecting to buy them back later at lower prices. Futures and the underlying stocks are linked by arbitrage, so heavy selling in futures quickly spilled over into the cash market. As the Dow and the S&P 500 dropped, more programs reached their triggers and joined the selling. Human traders watching the screens saw prices collapsing and, in many cases, responded by selling as well, adding emotional panic to mechanical pressure. By midday, the New York Stock Exchange was under intense strain. Prices on the screen no longer reflected a normal balance between buyers and sellers. There were waves of sell orders, but very few bids on the other side. Market makers, who are supposed to step in and provide liquidity by buying when others are selling, found themselves overwhelmed. Some widened their bid-ask spreads dramatically. Others backed away entirely, rather than risk being run over by an unstoppable flood of selling. The feedback loop had taken control. Programs were selling because prices were falling, and prices were falling because programs were selling. Fundamentals, such as corporate earnings or economic growth, were almost irrelevant in that moment. By the closing bell, the Dow had lost 508 points, a 22.6% decline in a single session. That would be equivalent to several thousand points in today's terms. Nothing like it had ever happened before. The scale of the move was not just frightening, it was mathematically shocking. If you model returns assuming a normal distribution, a move like Black Monday should occur once in many lifetimes, not within the career of a single trader. Yet it happened, and the core reason was that the structure of the market contained a mechanism that could magnify modest declines into a crash. In the aftermath, regulators and academics launched investigations. They concluded that portfolio insurance had played a central role in the disaster. In response, regulators implemented safeguards, such as circuit breakers that halt trading temporarily if indices fall by a certain percentage within a short period. The idea was that pauses would give human participants time to digest information and restore order. For a while, many in the industry comforted themselves with the belief that the problem had been solved. The reality was less reassuring. The specific product called portfolio insurance faded, but the underlying concept and its dangers were merely transformed and embedded into new strategies. Fast forward to 2025, and you find that markets are now dominated not by human traders standing in pits, but by machines passing orders to one another at speeds measured in microseconds. Algorithmic trading and high-frequency trading account for the majority of daily volume. These systems analyze streams of data that would be impossible for a human to process in real time: price changes across thousands of securities, order book imbalances, volatility spikes, news headlines scanned by natural language algorithms, even social media sentiment. Based on these inputs, they execute trades according to predefined rules. If certain patterns appear, they buy. If others appear, they sell or withdraw from the market entirely. At first glance, algorithmic trading might seem unrelated to the portfolio insurance strategies of 1987, but the structural resemblance is clear once you look closely. Both rely on rules that link price movements to automatic trading decisions. Both operate at speeds too fast for human intervention. Both dominate enough of the market that, when they move in the same direction, they can overwhelm traditional liquidity. We have already seen early warnings of how this can go wrong, such as the flash crash of May 2010, when the Dow plunged nearly 1,000 points in minutes and then rebounded almost as quickly. Post-mortem analyses showed that automated sell orders triggered other algorithms to sell or pull their bids, creating a sudden vacuum that allowed prices to fall through thin air. However, the most important modern echo of portfolio insurance is not just high-frequency trading. It is the massive ecosystem of passive investing built around index funds and exchange-traded funds, or ETFs. Over the last 2 decades, investors have embraced the idea that instead of trying to pick individual stocks, they should simply buy the entire market through low-cost index products. This has many advantages in normal times: lower fees, broad diversification, and a simple approach that beats many active managers. As a result, trillions of dollars have poured into ETFs that track everything from major indices like the S&P 500 to narrow slices of the market, such as technology stocks, high-yield bonds, or emerging markets. To understand why this matters, you need to know how ETFs actually function. When you buy shares of an ETF on an exchange, you are not directly purchasing each of the underlying stocks in the index. Instead, you are buying a claim on a pool of assets held by the ETF provider. Large institutions known as authorized participants create and redeem ETF shares. When demand for an ETF rises, these participants assemble the basket of underlying securities and deliver it to the ETF issuer in exchange for new ETF shares, which they can then sell to investors. When investors want to get out and sell ETF shares in large quantities, the process works in reverse. The ETF can return baskets of the underlying stocks to the authorized participants, who then sell those holdings into the market. This structure ties ETF flows directly to the buying and selling of actual stocks. Under normal conditions, it works smoothly and provides the appearance of constant liquidity. You can click a button and sell your ETF shares at the current market price. The danger emerges under stress. Suppose some shock causes investors to lose confidence and begin selling their ETF holdings. As ETF shares hit the market in large volumes, authorized participants step in to arbitrage any difference between the ETF price and the value of its underlying assets. To fulfill redemptions, they either sell the stocks directly or accept baskets of underlying stocks from the ETF provider and then dump those shares into the market. That selling pressure pushes down the prices of the individual stocks in the index. Lower stock prices then feed back into investor psychology. When people open their accounts and see the value of their index funds dropping, many of them respond by selling more. Pension funds, financial advisors, and automated rebalancing programs may also sell ETF shares once certain thresholds are breached. The ETF, in turn, must sell more of the underlying stocks to meet these redemptions. Just as portfolio insurance in 1987 sold more aggressively as prices fell, the passive investing machine does the same thing today. although the mechanics are wrapped in a different layer of abstraction. We saw a preview of this dynamic during the COVID-19 panic in March 2020, particularly in the bond market. Several large bond ETFs began trading at steep discounts to the value of their underlying holdings. That meant investors trying to exit through the ETF structure were forced to accept much lower prices than the theoretical value of the bonds. The problem was not that the bonds had defaulted overnight. It was that there were few buyers willing to take large chunks of them in the middle of a panic. Liquidity that looked deep in calm times turned out to be fragile when everyone tried to move through the same door at once. Central banks eventually intervened, buying corporate bonds directly and effectively backstopping the market. But that rescue should not lull anyone into thinking the structural issue has disappeared. Now consider the sheer scale of passive investing in 2025. In 1987, portfolio insurance may have influenced around $100 billion. Today, index funds and ETFs control well over $15 trillion globally. And the number continues to grow. Much of the retirement savings of entire generations is locked into products that track a small number of major indices. Meanwhile, many active managers anchor their portfolios to those same benchmarks to avoid falling too far behind, which further concentrates flows. When money enters the market, it does not carefully evaluate each company's fundamentals. It simply buys more of whatever is in the index, often in proportion to the company's market capitalization. When money leaves, the process reverses and selling pressure hits every name in the basket at the same time. Layered on top of this are leveraged ETFs that use derivatives to amplify the daily moves of an index, and complex option strategies used by traders and institutions. Dealers who sell options must hedge their positions dynamically. When the market falls, certain hedging strategies require them to sell stocks or futures to stay neutral. This is essentially another form of mechanical selling triggered by price declines. All of these pieces, passive flows, leveraged products, options hedging, algorithmic trading, are interconnected. Each one by itself may seem manageable, but together they create a structure that is primed for a cascade once selling reaches a critical point. The similarities to 1987 become very clear when you line up the main features. Back then, portfolio insurance programs were designed to sell automatically as prices dropped in order to protect portfolios. Today, ETFs and other passive vehicles end up selling the underlying stocks automatically when investors redeem shares, regardless of whether the fundamentals of those companies have changed. In 1987, computer models followed mechanical rules with little human judgment. In 2025, algorithms implement strategies at microscopic speeds without waiting for humans to understand what is happening. In 1987, many institutions used similar models, so their programs triggered at the same time, creating a synchronized wave of selling. Today, when one popular ETF sees heavy redemptions, others linked to the same stocks or sectors often experience similar outflows, creating the same kind of synchronized cascade. During Black Monday, market makers withdrew because they could not handle the volume or the risk. Liquidity vanished just when it was needed most. In modern markets, liquidity often appears deep as long as prices are stable, but much of it comes from high-frequency traders and arbitrageurs who will pull their orders in an instant if volatility surges. The result is that the apparent safety of being able to trade ETFs at any moment is somewhat illusory. In a true panic, the bids can disappear, and the process of executing redemptions can force ETFs to dump stocks into a market where very few participants are willing to buy. Another critical difference between 1987 and today is the speed and scale at which events can unfold. Black Monday's 22.6% drop occurred over the span of roughly 6.5 trading hours. That felt shockingly fast at the time, but by modern standards it is leisurely. With computerized order routing and nanosecond-level trading, a comparable or larger percentage move could occur in a fraction of that time. A cascade that once needed a full day might now compress into an hour or less, giving ordinary investors almost no chance to react. Circuit breakers can pause trading for 15 minutes after a steep drop, but once trading resumes, the same underlying mechanical pressures are still in place. Pauses do not eliminate the feedback loop. They only slow its visible expression. What makes the current situation even more precarious is how deeply passive investing has penetrated everyday financial life. In the late 1980s, portfolio insurance was mainly an institutional tool used by large funds. Retail investors, small family offices, and many mutual funds still relied on human judgment. Today, ordinary workers saving for retirement are heavily exposed to index funds and ETFs through their 401ks and pension plans. Financial advisors routinely recommend set-it-and-forget-it strategies built around passive products. Many people who consider themselves conservative investors are, in fact, participants in a highly mechanized system that will sell their holdings according to rules they barely understand once stress appears. The trigger for the next major cascade does not have to be dramatic. In 1987, analysts still debate which news story, if any, should be blamed as the initial cause. The truth is that the market structure itself was unstable enough that almost any shock could have set it off. The same is true today. It could be a geopolitical escalation that sends energy prices spiking, a sudden jump in interest rates as central banks fight inflation, a default by a large company that calls credit quality into question, or even an error in some algorithm that prompts a brief but sharp sell-off. Once prices begin to fall and break through certain technical levels, the machines will start to react according to their programming. ETFs will face redemptions, authorized participants will sell underlying stocks, volatility will spike, and hedging strategies will require more selling. At that point, the narrative you will hear on television will be filled with phrases like panic, fear, and loss of confidence. Those emotions will certainly be present among human investors watching their accounts drop. Yet the deeper reality is that the worst of the move will not be driven directly by fear. It will be driven by structure. When enough money is committed to strategies that sell when prices fall, the system becomes inherently pro-cyclical. Instead of dampening volatility, it amplifies it. Instead of providing liquidity in times of stress, it withdraws liquidity precisely when it is most needed. After the fact, there will be calls for new regulations and inquiries. Experts will debate whether algorithmic trading should be limited, whether leveraged ETFs should be restricted, whether circuit breakers should be redesigned. Some reforms may be useful, but none of them will change the central fact that as long as trillions of dollars are funneled through mechanical strategies, the market remains susceptible to sudden, violent adjustments that have little to do with long-term fundamentals. This brings us back to you and your portfolio. Many investors comfort themselves with the belief that because they are long-term, they can ride out any storm. That attitude can work if crashes are relatively moderate and spaced far apart. But if the market experiences a drop of 30 or 40% in a very short period, the psychological pressure can become unbearable, especially if you are nearing retirement or have financial obligations that cannot be postponed. Watching a lifetime of savings cut in half overnight is very different from enduring a slow bear market. The historical record shows that a rapid, severe crash can change behavior for decades. The goal here is not to scare you into abandoning the market altogether. It is to encourage you to understand the machinery operating beneath the surface prices you see on your screen. When you own index funds and ETFs, you are not just holding a diversified basket of companies. You are also plugged into a set of rules that determine how those funds behave under stress. You are part of a network that can, under certain conditions, act in a highly coordinated and self-reinforcing way. Recognizing that fact is the first step toward making conscious decisions about how much exposure you want to have and what kinds of hedges or alternative assets might help you weather a structural shock. If this breakdown has changed the way you think about the stock market, and especially about the safe, passive strategies that dominate modern investing, then stay with this channel. Understanding the structure of the system is one of the few real edges ordinary investors can develop. You cannot outcompute the algorithms or move faster than high-frequency traders, but you can educate yourself about how they behave and position yourself accordingly. The next Black Monday will not politely wait for you to catch up. It will arrive the way all such events do, suddenly, mechanically, and with no regard for whether you were paying attention.